Okay, just please have a look at this for a second. I'm not going to read it. And if you have questions after, please ask them via the chat function on the GoToMeeting panel. So let's talk about Purple Chips. First of all, just a quick review. I'm not going to go into a lot of detail about this because a lot of you have already read the book or you've seen the presentations or you've met me. So I'm not going to go into too much detail about the fine points of Purple Chips. We'll get into that after as we show the live examples. Purple chips are essentially they're higher quality, better than blue chip stocks, okay, and you'll see that as demonstrated by the earnings progression that becomes fairly obvious what a purple chip is. And I'll make the distinction between blue chips and purple chips. There's really three criteria when we talk about purple chips. If you read the book, you'll see that it's really simple. There's only stable and predictable earnings, 7 years plus rising profitability, in other words, growing earnings per share, and a market cap of about $1 billion. And that's because we need size. We like big companies because they're more stable, they're more predictable, and the analogy that I give in the book, they don't get batted around by a small wave, let's say, or a big wave, for example, or something bad that happens in the market. Now let's talk about purple chips a little bit. We've been in the news quite a lot. We've been in the Wall Street Journal, Bloomberg Radio. We've been on Jim Cramer's TheStreet.com, Yahoo Finance, Business News Network, etc. And many things. So we're all over the place. Now I'm going to give you a quick recap first before I go into all the details. I'm going to give you a little bit of a recap layout of what we're going to be seeing today. I'm going to start with a overlay of purple chips, and then I'm going to go into the positions, okay, the things that we've actually done and closed, and the open positions, the things that we recommended and that we're still holding, and then we're going to go into the different ways that you can invest in purple chips, either via the website as a subscriber or via investing and working directly with me. And so I'll talk about the differences, the advantages, the disadvantages, etc. After that, we're going to talk a little bit about live examples. We're going to go straight to my Thomson One screen, which you're going to see, and you'll see stocks as they close today, and you'll see them with the overlay of the earnings on them, and you'll get a good sense of why purple chips are so attractive. So let's start with that. I'm going to go back to the presentation here, and essentially our performance has been pretty interesting. The purple chips, the top 25 stocks, are up 38% since the high of the market. Okay, and the high of the S&P was in October 2007. Now, if you compare that to today, the S&P is only up 4%. So the S&P, if you had invested $100,000 back in October 31st, 2007, and you were unlucky enough to have done that at the peak of the market, today your $100,000 would be worth $104,330, so just 4% higher. However, if you looked at the top 25 purple chip stocks, you would actually be up 38%. And so you can see, I'm going to grab my little pen here. Minute. Okay, you can see how this would have been your money at the top of the market, and during the crash in the market we actually came down, and you'll see the purple bar here indicates how the purple chips did, and the gray bar down here, this is the S&P. So $100 invested in the S&P would have gone down to $52.13. Whereas that same $100 you did lose with purple chips. Okay, those top 25 went down to $67.07, but very quickly you see what happened with the purple chips is that they kept on rising, and they rose much, much faster than their corresponding index constituents. So the S&P 500 went from $100 to $104 over the same time frame, which is to August 30th, by the way. And the top 25 purple chips went to $138. So we've got a 34% difference there. So purple chips, the top 25 are up 38%, and the S&P is up 4%. Now on the Canadian side, it's even more interesting. Okay, the top 10 Canadian stocks are actually up 88% versus the index at the high, which was down 13%. So you can see there's a real marked difference in the performance there. Now let's continue. Whoops, hold on 1 second while I erase my drawings here. Okay. Sorry, let me go back. Okay, now who are the purple chips? Basically, in Canada, there's about 40 or so companies that fit the bill, that have stable and predictable earnings. And who, on the U.S. side, we've got about 250 companies, actually 246 on the list there. I think there's 249 as of today. And they're companies that most of you would know, and there's a lot of companies you don't know. For example, if I talk about Church & Dwight, this is a company that makes Arm & Hammer baking soda. So Church & Dwight is right here. They have big brand names. There's other companies in here. Some of them you recognize, of course, Google, IBM, MasterCard, which is amazing, Johnson & Johnson, McCormick, which makes the candies, Oracle, software, Medtronic, a fantastic medical device company, Sigma Aldrich, Stryker, Walmart. Everybody knows Walmart. I hate Walmart. Don't know if you hate it, but I own it. Better to own it and make money than to shop there. That's the way I see it. So anyhow, and there's lots of other companies too. We've got a whole list. You can go on the website and actually see the whole list of companies that we've got there. Okay, now, just moving on. Okay, purple chips is really simple. There's only a few steps. Very simply, we identify the purple chips. We buy them when the valuation hits the low target. We hold them, and then we sell them when the valuation hits the high target. And we keep repeating the process. So we're looking at these fantastic companies. We're waiting until they become really low risk and very attractively valued. And we go in, we hold them until they get reasonable to high valuation, and then we take the profit, and then we take our money off the table and recycle it into the next opportunity. Now, what have we done? Since we started publishing our alerts, okay, and this, what I mean by that is these are the stocks that we felt were the very interesting opportunities. We had enough time to look at and study these opportunities, and these are stocks that we purchased, and you'll see there's an entry date, entry price on here, and then the exit date and exit price, and you can see how much we made. Now, keep in mind this table excludes any dividends that we made. And on the website, by the way, we talk about total return, okay? So the numbers are slightly higher on the website because they include the dividends. Okay, so these numbers that you're seeing on the table in front of you are actually net of dividends. Okay, so the dividends actually add a few percent because most of these companies do pay dividends. So moving on, this is the second page of the closed positions, and you'll see that in spite of having a few positions that did lose money, we have quite a few that, many more that made money, of course. And that's the whole idea behind purple chips, is that we invest our money and we should be able to make 20 or 30% on these things. And that's typically what I expect with most of these companies. So when you buy them at a low valuation and you subsequently wait and let them mature, let's say, and reach their full valuation, you should be able to make 20 or 30%. And sometimes it's more than that. Sometimes we'll hold a company and it can go for a long time, and it will, you know, take a long time before it reaches its target because the target can change as the earnings increase. I'll get into that detail later. That's maybe a little too technical. These are the open positions, and the open positions are kind of fun because had you looked at this table maybe a month ago, you would have seen that it didn't look the same. There were a number of positions that we still had on our list that we've since closed, and you'll see that a lot of these positions were substantially lower than when we initiated them, or rather than where they are today, sorry. And so what I mean by that is that every week as time passes, these companies are producing more earnings, and they're great companies. And so they tend to, if we buy them at a low valuation, they tend to appreciate. And so you see this gradual improvement. Because a few weeks ago, we didn't have you know, the number of stocks that we have on this list that are over 10%. Now we've got, you know, a couple that are plus 20 or more, and we've got 3, 4, 6, I don't know, there must be at least 10 stocks that are making more than 10% on the list. And that wasn't the case. I mean, obviously we bought, every one of these stocks were bought and we were not making any money. Now when you look at this table, the one that's in black, you can see anything that's plus or minus within 1%, I always keep it in black. When it's in green, it's because we're making more than 1%. And of course, when it's in red, we're losing money on it. Now, there's another thing too. You'll see there's a column here called position size. And we talk about half positions and full positions. Now, a full position, if you had $100,000 worth of stocks, okay, a full position, the way we look at it, and this is portfolio management, let's say, practices that you should employ. A full position is 5% of your equity positions, okay? So if you, in your portfolio, have $100,000 of stock, then a full position for you should be about 5%. And the reason for that is because you get your maximum diversification at about 20 positions, which is 20 times 5%, so that gives you 100%. A half position, the way we define it, a half position is for stocks that don't pay dividends, for growth stocks. Okay, the value stocks that pay dividends, we go for a full 5% position. Half positions are for the growth stocks, 2.5%. So you can invest in Purple Chips in two ways. One is through the website, purplechips.com, and that's a pretty inexpensive way of doing it. And there's advantages and disadvantages to doing this. This is really well suited for disciplined investors that know what they're doing. Okay, they understand the rules, and they follow a plan. Okay, if you're not in that group, you might want to consider the second option, which is working directly with me. I work with a lot of people that are very busy, or that maybe don't have necessarily the time or the interest to look at every single stock and figure out whether they should do it, and figure out the allocations, and all those things. So that's my job as a professional, is to manage portfolios for people, to implement them the way we do on Purple Chips, and to keep doing that. So I do it over and over, and to follow and to have the discipline. So there's two options. You can do it yourself, or you can work directly with me. If you do it yourself, you've got a choice of a monthly or an annual subscription. The monthly is not expensive. It's about $39 a month, I believe. Is that correct, Mark? And the annual subscription is $348 plus tax, of course. And you have full access to the Purple Chips website. You've got action alerts for all your investments. You gain an increased understanding of why we buy or sell different stock, because we actually publish an alert which tells you exactly what's happening. And you get notifications via Twitter. So that's kind of fun. We also produce weekly updates. So every week, since we've been doing this, and as long as we're going to do it, which is going to be years and years from now, we're going to keep producing these updates, and you'll get a lot of information. And you'll also get reasonable access to me via email or telephone. I have a number of subscribers that will contact me directly and ask me questions about different stocks. If you work with me directly, it's a slightly different game. Okay, we have discretionary or traditional portfolios. I'm a member of a very large group at Scotia-McLeod. We manage in excess of $3.5 billion. We have a team of 15 that serve, some of Canada's and wealthiest families. We work on a fee-based arrangement, and so you can see the fees right there. And at the end of the day, we don't have any unhappy clients, so we're happy about that. When you work with me, you get professional portfolio construction, you get discipline buying and selling, and that, believe me, that's probably the most important point, is that I follow the plan. Okay, that's what people are paying me for. So if you're a busy executive and you don't have time to do this on a daily basis, you might want to consider that. You get full access to the Purple Chips website. You get action alerts, and you get all kinds of information. So that's it. Those are the two differences. Here's my contact info. Now, this is the fun part. We're going to go into the live examples. So, hold on one second. What is this? Oh, and all alerts and updates are available on the website. So anytime if you look on the website, you're going to find all the information that you need. So let's go into examples here. Now, every day we're bombarded with information about great stocks to buy. Okay, this is a copy of an article that came out in the Globe and Mail back in July. And you can read the heading. It says, in search of cheap, safe U.S. stocks. So on the list, you've got some great companies. You've got Microsoft, Berkshire Hathaway, Cisco, et cetera, et cetera. But you got a whole bunch of stocks on here that are labeled as cheap, safe U.S. stocks. And some of these stocks, it was kind of interesting. I went through them all, okay, every single one of them. And I found, I thought I would discuss a little bit about what these stocks are. So let's have a look here. We're going to talk about some of the stocks on the list, and I highlighted 3 of them. Okay, we're going to look at Foot Locker, which was on the list, Cooper Tire, and Benchmark Electronics. So first stock is we're going to look at Foot Locker. Okay, I'm just going to type this in here. Here's Foot Locker. Now, I want you to see what the difference is between a stock like this and a purple chip stock. So what you're looking at here is a 20-year chart of Foot Locker. And what you see is this on the top pane, the yellow lines, okay, are the monthly variation in the stock price. So you can see that the stock price has been all over the map. It's gone basically from about $6 up to $36. And the white line that you're looking at is the earnings per share on a quarterly basis. So every little step in this white line represents a little bit of change in the earnings per share. It's the trailing 12 months earnings per share. Okay, so you can see, looking at this, Foot Locker basically started. I'm going to grab my pen. Hold on. Okay, so Foot Locker started with earnings around $1.80. They went down. They went up. They went down again. They went up. They went down again, and they went up. If you ask me, that's kind of unpredictable. Okay, so that does not fit my definition of a purple chip stock. Now, let's look a little further at some of the other stocks that are on the list. Okay, so I said Cooper Tire. One second, whoops. Okay, this is Cooper Tire. Now, again, what we're looking at, we see a white line, which is the earnings per share, which drifted for a few years, went down sharply, went up, went down, came up. Now it's starting to go up. This is not my definition of stable and predictable by any means. Okay, so this is Cooper Tire. That was on the safe and cheap list of stocks. Okay, in search of cheap, safe U.S. stocks. That's what the title said of the article. So when you read an article in the paper, you see that kind of thing, you should be a little bit skeptical. Okay, now let's talk about Benchmark Electronics, BHE, on the U.S. market. What do we got? BHE. Okay, generally the earnings, if you look at the white line, you can see earnings trended up over the years. The stock went from about $6 up to $23. Okay, that's not bad, over 20 years. But it had significant volatility in earnings and in price. And note, whenever you look at this, you see how the earnings move. The earnings move in a certain fashion, and the price generally follows the earnings pattern. And that's an important notion or concept to understand. Now let's talk about some big blue chip stocks, okay? So we're going to talk about 2 blue chip stocks that I love talking about because everyone calls them blue chip, and I don't see anything blue about them. So let's talk about DuPont. Okay, this is a blue chip stock, and what you see here, this is a stock that pays a nice dividend, 3.1%. Stock's trading around $58. Well, guess what? Today, we're earning $3.27 a share, and if I go back to this period, okay, let's see now. That was around $3.60 a share, and that was back in 1997. And today we're earning $3.27 a share. It's not very exciting to me. And you had earnings going down, you had earnings going up, earnings going down again, earnings going up, and finally coming here. So in the last 15 years, this is what earnings did. Not very fun. I don't like it. Say hello to my cleaning lady. Okay. Let me just erase these drawings. Okay, that's okay. All right, and next thing, let's talk about AT&T. AT&T is an interesting one. and a very similar situation. Again, this is a blue chip stock. So you've got AT&T, you've got rising dividends over the years, and you've got earnings going up until about 1999, going down then in 2004, and then up in 2008, down, and then flat ever since. If I take the pen, you can see over here, earnings peaked, but in fact, for the last 14 years, earnings have been pretty flat. I'm really not interested in investing in companies like this because you're not putting the odds in your favor when you buy a stock like this. And I understand you could have bought AT&T down here and wrote it up here, and that would have been fantastic. You would have made good money. It went from 22 up to 40. This is what analysts love, okay? They look at a small little sliver at a time and they say, well, look, AT&T's blue chip. You know, we went from 22 bucks up to 40 bucks. It almost doubled. Who cares? Okay, because the fact is that after it went to 40 bucks, it went right back down to 24 again, and then it went back to 36. So that's not a predictable earnings pattern. It's not the kind of thing that we want to invest in. Okay, I'm interested in making money without the pain of being wrong. Okay, without the pain that comes with earnings going down unexpectedly, and that's what you see when you get stuff like this. Okay, now let's talk about some of the other stocks. Okay, now let's talk about some purple chips. Okay, I love talking about these two stocks. I'm going to bring up Oracle. Now watch the difference here. This is Oracle, and you can see the progression of earnings is very smooth, and the stock price followed the whole time. Now, there was a period during the tech craziness, the tech lunacy, if you want, okay, this period right here, where Oracle went and flew basically to the moon and came right back and landed back on Earth, okay, during this period. But it's very interesting because if you look at the earnings did this, okay, and they went up, and then they stabilized, and they continued going over the years. So the earnings never really had that lunacy that you had with the price. That tells you a little bit about how the stock market works. Okay, price often moves independently of the reality of earnings. Now, if you own a business, what really matters is the earnings. It's not the price, it's the earnings. Okay, and that's the whole concept, the whole notion behind purple chips is you've got to focus on earnings because the price has all those things that they don't mean a lot to you. It's all the noise built into it. Okay, and so you've got this nonsense that happened there for a little while. But the reality is that this company produces beautifully steady and predictable earnings. And this is, Oracle is in the top 25 of the purple chip stocks, okay? Out of the 250 or so stocks that we look at, Oracle is one of the top 25. And the reason it's in the top 25 is because even during times when things were bad, okay, like during the credit crisis, which was this period here, okay, notice how the earnings kept on going up. They barely lost, they didn't really lose anything here. They just kind of stabilized and then they went up again. That's the sort of thing we're looking for. So the top 25 stocks all have the same characteristics, okay? They have unbelievably smooth earnings that never miss a beat. Okay? This is the kind of thing that we're looking for. So purple chips is about identifying these companies and buying them when they're cheap. Okay, so this is a good example of a purple chip. Okay, now I'm going to show you National Bank, which is another one. That's very interesting. Now this is on the Canadian market here. This is on the TSX. And look at the beautiful earnings progression on National Bank. Now note that the price dropped during the credit crisis, and so you had the price going down like this. But very interestingly, the earnings never lost any momentum, and they just continued. We had a couple little blips, but they continued going up over the years. So what happened was the price actually started going back up too to follow those earnings. That's what happens when you have great companies. Okay, there's opportunities that present themselves when the markets get nasty, when things get really emotional, but they create opportunities to make a lot of money. So now let's talk about, let's go actually, this is the fun part. Now we're going to go to questions, okay, and we're going to, actually, hold on a second. Before we do that, before we go to questions, okay, we're going to talk about some of the examples of stocks that we've done that we're invested in. Okay, some current examples. So it wouldn't be good to jump to questions when we still have lots of fun stuff to cover here. So let's look at IBM. IBM is a stock that we are invested in. Okay, we originally bought this at 194. This is what the earnings curve looks like. It's a top 25 purple chip stock. Okay, we bought it when it was at 194, and right now the stock is at 190.75. That's as of the close today. This is a live chart. Okay, as of today, and what we expect. Okay, you see. Let me explain. I'm going to back up for a second here. The white line, okay, that you're looking at, that's the earnings per share. The way this white line changes over time, okay, is that every time a company reports earnings, like IBM reports its earnings, it adds a little notch on there because it's the trailing 12 months. So in other words, it's the sum of the last 4 quarters of the earnings. So when you see in this example, it says IBM earned $15.92, okay, which is this number right up here. They earned $15.92 a share. The $15.92 is actually the sum of the last 4 quarters, okay? So that tells you a little bit about how the trailing 12 months earnings works. Okay, now, what happens is that this white line is actually pegged to the last trading price of on this chart. So it's the last trading price, and so you can imagine that if the stock price was at $210 or $215 back here, okay, actually I'll take the pen, okay, right here, that earnings line would have been shifted much higher, okay, and that's the whole notion behind purple chips, is that you can actually see valuation ranges by moving that earnings line around, okay, and if IBM was at $220 today, this is essentially what it would look like. And that tells me when that earnings line is shifted up, okay, that's an indication of higher valuation. Okay, so in fact, when IBM is down here, that is at a low valuation compared to the historical range of valuations. Okay, and I like to look at, like, let's say the last 2-3 years of valuation to get an indication of what the current valuation range is, because that evolves over time too. So there's IBM. Now let's talk about another stock that's currently, I think, a pretty attractive proposition also in the tech sector is Broadcom Broadcom Corporation, actually, sorry. Here we have, I'm going to change something on this graph just a minute. Hold on one second. Okay. I'm just going to make the time frame a little lower because it gets a little skewed by the tech bubble. So this is looking at the same chart, okay, but I just took a slice of it from 2002 until now. And this is kind of interesting because what you see is that the valuation, okay, based on the position of the white line, is at the lowest that it's been. It's actually equivalent to what we saw in the worst case during the tech bubble. Sorry, that was my wife calling. Excuse me. So, anyhow, so this is Broadcom, and this one's quite interesting. This is fun because at this valuation, this is really interesting. It's a very low valuation, equivalent to what we saw during the credit crisis. Okay, and if Broadcom, okay, the earnings are going to be flat for Broadcom for probably another year or two. So I don't expect the stock to necessarily move up a lot, but I don't think it's going to move down either. So, so what I'm expecting is that on the high end, you could see this stock probably run up to about $38. And that would be a reasonable valuation. And it would actually be not the highest valuation that we've seen, but I mean, Broadcom, if the earnings start rising, you could see the stock easily get into the 40s again. So this is a very interesting one. Hold on one second. I have to call you back. I'm going to call you back, okay? Okay. Yes. So that's Broadcom. Let's talk about some other stocks that we've been involved in that have showed up on the model, actually, and that have done spectacular moves. Let's look at Priceline. Now, this is a very interesting one, okay? Look at the earnings curve on this, and you can see how this stock was unbelievable. Now, I have to tell you, I actually bought this stock around 600 and something dollars, maybe 625, because I was looking at this picture, and the earnings were way down there. The earnings were still progressing upwards. To me, this looked like a screaming buy, and it turned out to be correct because the earnings continued. Okay, so we looked at the forecast going forward. This stock looked like a no-brainer. Okay, and I figured when it was around 600, 650, this was pretty low risk, and I estimated at the time that the stock could probably get up to about 850 or so. And actually, the earnings continued, and look at where the stock is today. So that kind of tells you something about how earnings matter. Okay, and how the position of the earnings line, when you overlay it on a graph, can tell you a lot of information. It tells you about the quality of management because it's stable and predictable earnings. Okay, it tells you about valuation. It tells you about the historical valuation rate, and it tells you when there's opportunities for you to make money. So, so that is those are a few examples, and I'll throw another one at you. One stock that I've been tweeting about recently is MasterCard, and this is a really interesting one. And MasterCard is you know, in my view, it's kind of expensive, but just look at the progression of earnings on this company. It's been phenomenal. And I think part of the reason that we're seeing this is because it's a move towards this is proof that our society is moving towards a cashless society. And the big benefactors of that sort of thing, this is paradigm shift, okay, where people aren't going to use cash anymore, or way, way, way less cash than they used to. The big benefactors of this kind of movement are companies like MasterCard and Visa. So the credit card companies are going to be the big, big winners in this. That's why this stock keeps getting more and more expensive. So this is a purple chip stock. It's not at a low valuation yet, but there's going to be some time in the future, okay, when there will be a correction. And maybe if the stock came down to, I'll tell you, we would be a buyer of MasterCard based on the positioning of this earnings line, okay, probably somewhere around 570 or something, maybe a bit lower than that. So if you had some kind of a sell-off in that stock, we'd certainly be there. So now what I'd like to do, we're about 37 minutes into the presentation, and I'd like to open it up. Those ones on the list? Oh, okay, so okay, sorry. You know what? We're already doing questions. So I didn't realize that. So, okay, so people have been asking. Okay, yeah, use your chat function, okay, if you got questions for us, okay, use the chat function because I've got my colleague Mark sitting in front of me here, so he's actually giving me cues of what I should be responding to. So I talked about IBM, and the reason I'm talking about these stocks is because I wanted to talk about them, but it's also these are questions that came up from people that are subscribers or interested parties. So keep throwing the questions at us, okay? So we talked about IBM, we talked about Broadcom, Priceline, MasterCard, Church & Dwight, CHD. So someone's asking about Church & Dwight. What do we think of CHD? This is a fantastic company. I love this company. Okay, they're the guys who, I said it before actually, Church & Dwight does Arm & Hammer baking powder. They also do Trojan condoms. So, I mean, you don't know the company name, but you actually know the brands. Okay, and there's a lot of companies like that. It's quite interesting. Now, Church & Dwight, okay, if I was a buyer of Church & Dwight, okay, I would be looking to buy it around the 56 or lower area, okay? Now, I'm saying that, okay, without having looked at our actual numbers on the website or on the spreadsheets that I use to determine the valuation targets, okay? Because the other thing that we do, I'm going to throw in something else here. There's something else that we look at, okay, which is the forward earnings, okay? And you'll see in a second, this is the kind of thing that we look at, okay? Part of our research involves looking at not only what happened before, but we want to know what's going to happen in the future. So we're looking, and you don't see this stuff on the website, okay, but this is what goes into, when we give an alert on a stock, it's because we've looked at the back end, okay, the historical performance, and we look at the forward performance, okay, the expectations on earnings, We do the roundup of all the analysts, okay, what they're thinking. So this is objective analysis, okay, but we need help from the people that really know these companies, intimately. So I look at those forward earnings, and what you see here, okay, you're looking at this page, you're wondering what it is. This is the bottom line here, okay? So Church & Dwight, in 2013, they'll earn about $2.80 a share, okay, and you can see the actual number here was $2.60. They're expected to earn at the end of their fiscal year $2.80 a share, and that's going up. $3.10 in 2014, $3.37 in 2015. That's the kind of thing we like, okay? So I always want to see that earnings progression where things are always rising like that. So we look at these things, okay? It's part of our analysis in every single stuff that we talk about, okay? And it helps us determine what the real low valuations and high valuation targets are. So that's Church & Dwight. Now someone asked about Stryker. So we've been involved in Stryker a few times. And they said, what now? So what's happening with Stryker? Well, I'll tell you, Stryker got expensive. Okay, last time we got involved in Stryker, it was around in the low 50s. I'll just move this earnings line here. Okay, and so we were involved there. We ended up getting out of Stryker, I believe it was in the mid-60s or so. I don't have the website in front of me, but I know it was around there. And the stock since moved up. Okay, it moved a little higher. It might even go a bit higher than that. Okay, historically, this is still a pretty reasonable valuation for Stryker. But my job is to point out when these things are really low risk. Okay, we follow 250 stocks, and so my job is to show you when the real deals are showing up. Okay, like the IBMs and the Broadcoms and stuff like that. Okay, these are stocks that I like because I think they're pretty low risk at this point. Now, another thing I'll mention, part of our analysis, because I like talking about the real due diligence that we do, we also look at things. We look at the cash positions of the company. So I'll go into the financials and look at the ratios, and so this is the kind of information that I get. I'm going to look at enterprise value. I want to know if these companies have cash on the books or if they're debt laden. Obviously, I'm going to favor companies that have cash on the books. And look, here's an example. Stryker Corporation, this is a company with cash on the books, okay? The market cap, I'll take the pen, I'll show you this, okay? This is the sort of thing that I look at. Here you've got market cap, $20 billion, almost $21 billion, and enterprise value, okay? For those of you who don't know what enterprise value would be the market cap of the company, and then you take off the amount of cash that they have. And the reason you do that is they say enterprise value because this tells you how much money they actually need to run their business. So if a company has a market cap of $21 billion and they've got $3 billion of cash sitting on the books, then their enterprise value is actually $18 billion. Okay, and that's what this is telling you here. Now, if Stryker, okay, I'll just use this example, if they were a $21 billion market cap and they had $5 billion of debt, then you'd see enterprise value being the other way. It would be $26 billion because they would need that $5 billion to run their business. Okay, so enterprise value is a pretty important notion. So anyhow, I don't want to digress too much on that. So that's the kind of research that we do on these companies, and I hope I've answered a few questions there. Now, keep those questions coming on the chat function. Okay, someone is asking about HMS. That's from Michelle. HMS. That would be HMSY, I believe. Okay, HMS Holdings. Okay, let's talk about that one. Let's look at the chart. HMS. This is an interesting company. Okay, I know it's on our buy list right now, and I'll tell you why. Okay, obviously it's because the valuation right now. This shows you. I mean, look at the earnings position. The position of the EPS line here is telling you that HMS is at a very low valuation. If HMS gets expensive, it can easily get up in here around the 30s. Okay, and let's have a look at the forward earnings on this one, just for fun. Again, this is what I like. Okay, you see earnings, 86 cents, 87 cents in 2013, 108 in 2014, and 124 in 2015. That's the kind of thing you want to see. All right, so that's HMS, and oh yes, and Mark tells me that we did exit Stryker at $65, so we were in the mid-60s, as we said. Okay, so do we have any more questions now? We're at 5:45 p.m. We're 45 minutes into the webinar. Let's see if we've got anything else coming up. DTV. So I've got someone asking about DTV. DirecTV, this is a company that we like, that Warren Buffett actually got involved in. You can see the earnings profile here. And let's have a look at the chart. Okay, this is interesting. On DTV, remember we had buy signals in this zone here in the 50s, and I'm pretty sure that we said the high valuation would be in the 60s, and it did get up there. Traded up to about $68, and you can see it's around 62 now. If I was going to buy DTV again, okay, the thing that you should see here, okay, DTV is trading at 12.5 times earnings, all right? Sorry, 13 times earnings. That's not a very high multiple. It's got a good earnings growth. Okay, the prospects for growth are pretty good. So more than likely, I don't think the stock is going to get much lower than you know, the high 50s. And I would expect that at some point you're going to see DTV get up to the 68, 69, even $70 range, maybe even slightly higher. What we're seeing is a lot of companies in the last year, you're getting a little bit of PE expansion, okay? And so DTV could get up to the market multiple, okay? And if DTV hits $71, it'll be trading at 15 times earnings, which is not that rich, in fact. So that's that would be an interesting one there, but it's got to be at the right price. Okay, now we have questions about CEO, which is a stock that we own. We bought it around, I think it was around 170, and it's still on our list, and it's currently at 206. And we have a target of about 240. And the reason we have a 240 target is because we're looking at historical valuations. We're looking at the multiple. Okay, it's only trading at 10 times earnings. If it trades to 240, that's only 10 times earnings. Right now it trades at 9 times earnings. We know the earnings are still growing. So this is still a good company with good prospects. You know, at $220, maybe I'll revisit it. You know, it depends on how we feel about crude. This one has the influence of crude, so it can be a little bit you know, our view can change depending on how the outlook for crude changes. Let's talk about Intuitive Surgical. Okay, I'm getting questions about that one. This is a really interesting one. This is a one-product company, but I'll tell you, it's a fantastic company. Okay, this is a company that doesn't pay a dividend, so it's a good stock. They have the Da Vinci surgical system, and this is a big deal. This is a $15 billion company, so obviously their product is pretty widely used in surgical whatever rooms, procedures in rooms, blah blah blah. Anyway, this is a very interesting company. Now, thing you should note about Intuitive Surgical, it's a one-product company, but also have cash on the books. Okay, I always favor companies that have a lot of cash, and Intuitive Surgical does have cash. So I'm watching this one very carefully. I know I've sort of put out a caveat about this because it's one product, but anyhow, it's an interesting one. So you know, I may publish an alert on this. I'm not sure yet. So it's I'm trying to direct people to the lowest risk propositions out there. Someone is asking about Aflac, AFL. You know Aflac because of their great commercials with the duck, where the duck goes Aflac. Anyway, they're pretty funny commercials. Aflac was interesting. We were involved in this one. We made money on it. I think we had bought it in the low 50s, if I'm not mistaken, or was it the mid 40s? It was in the 40s, sorry. We bought it, so we actually bought it down here, 41. Oh, okay, so see, we're smarter than I thought. We bought it at 41, and that's because the valuation was down here. You can see that with the positioning of the earnings line, it was like an absolute steal. And I think we got out, it was in the 50s, right, Mark? Yeah, we got out in the 50s, and of course the stock did go higher, so it went up to 62, and it might still go higher. I want you to realize that my mission in doing this is not to try to milk out every last little possible penny of profit, okay? We should be getting in stocks when the risk is low, and we want to get out. I don't mind leaving some money on the table. That's okay. You know, let someone else make that last 5% or 10%. What I'm trying to do is I want to recycle those funds. I want to put them in the lowest possible risk propositions, okay? I want investments that are sure. The thing is, I know Aflac could go higher, okay? Historically, the valuation on Aflac is much higher, but you know, there's some risk with this stock too. It's an insurance company, okay? The market's changing, you know, insurance claims are going up. There's more hurricanes, more disasters, more of this, more I mean, Aflac was heavily involved in Japan, pointing out reasonable valuations for these things, and we take the profit then. Okay, I'm not trying to make, you know, I'd like to make 100% on an investment, but that's not the objective because I know that's much harder. So, anyhow, so that's a little bit about Aflac. Someone is asking about EW, Edwards. I love this company because it's got a long ways to go, and we own it. Okay, we bought it when it was down here, and I think it's completely reasonable that this stock can get at least to 90 bucks, if not more. Now, I want to show you what the outlook looks like for Edwards. This is the picture here. You got earnings trading, running around 307. They should go up to about 421. Now, let's look at it for a second. Okay, if Edwards earnings go up to 421, oh, guess what? That's even off the chart. So you're going to see this stock, you know, the shares traded up to $110 when the earnings were only $2.40, and they're expected to earn $4 a share. So if it goes to $4 a share, holy cow! I mean, this stock could easily go to 100 bucks. So anyhow, so that's a real interesting one. Edwards is a lot of fun. Someone's asking about AutoZone, AZO. This is a real amazing one. I wrote about this one in the book. It's one of the case studies, and it's kind of fun because it's got a beautiful, beautiful earnings progression. Obviously, as people keep their cars a little longer, they're buying parts for them, they're fixing them a little more. And this one is fun because as the earnings increased, the valuation didn't increase, but the stock price just kept on going. It didn't really present any opportunities for buying, but it did very recently. Well, I guess about might have been 9 months ago or something, when the stock was around 360 bucks. There was an opportunity to buy this thing, and then after that, of course, the stock went up to here. So I think a high valuation for this one would be around 450, something like that. And the low valuation is probably closer to 370. Okay, we got a couple more questions. Someone's asking about BNS. Michael is asking about Bank of Nova Scotia, my employer. So I won't say anything bad about them, except that we like to buy BNS around 57 bucks. Okay, and a reasonable target for this one, if you put it up here, move that earnings line up so that it's not at the highest historical valuation, but I think it's possible to trade up to 12.5 times earnings. That would put a target of about $64, $65 on the stock. So I think that's entirely reasonable. So we're making money on our banks now, and I'm pretty happy about that. Okay, someone is asking about Kimberly-Clark, KMP. Oh, that's Kinder Morgan, sorry, KMP, Kinder Morgan Energy. Okay. This isn't a purple chip, okay? There's two problems with this stock. Kinder Morgan, and I'm glad you brought this example up. The reason I wouldn't, you'll never see Kinder Morgan on the list is because, first of all, they've got a heavy commodity exposure. Okay, Kinder Morgan Energy Partners, okay, so that tells you a lot right there. But the other thing is you can see the progression of the earnings. This is it's not the sort of thing that we look for in a purple chip. It's a good company, okay, but it doesn't have the hallmarks that we're looking for. Now let's just look for information purposes. Let's look at what the earnings outlook is. The earnings outlook is actually reasonable. You've got rising earnings there. That's not bad. If I had to guess, based on the way we look at purple chips, Kinder Morgan is probably reasonably valued. If I look at historical valuation ranges and knowing that there's a possibility that crude oil could come down if tensions in Syria decrease, I would be a little bit careful on this, okay, and being the cheapskate that I am, I would only buy Kinder Morgan about probably $10 lower than where it is. That's where I would feel it would be worth the risk, okay, and that's provided that they still have a positive earnings outlook. On the high end, if you already own Kinder Morgan, it's not impossible the stock could go to 80 or 90, or sorry, 85, 90 bucks, but that's about it. Okay, let's talk about TDG. I don't know this one. Okay, TransDigm Group. Oh, look at that. Someone just pointed out a new purple chip. Actually, it's not. And the only reason is because I don't have enough earnings history on it yet. Okay, I need 7 years for this to qualify as purple chip, but this is a darn good company. All right, I don't know this company, TransDigm Group, but I can already tell it's pretty interesting. So it doesn't pay a dividend. It's an expensive stock in terms of price, $145. It's got a market cap 7.6 billion. Earnings have been flattening out lately. I mean, just without doing any further research, I'd say low end of the valuation range, 128, 130. High end of the valuation range would be somewhere in the 155, 160 area. Okay, so right now you're in the mid zone. If you look at the earnings outlook, it's actually pretty good. It goes from 667 a share up to 854. So I like that. So this is a good company. It's not a purple chip yet because we don't have that 7 years of history, but it's certainly on its way. So this is a company that I would consider as soon as I've got that 7 years of history, because I want to stick to the rules, okay? That's one of the fundamental criteria that we use in determining these companies. And the reason is because at 7 years, they've been able to ride out a business cycle. Okay, business cycles, I mean, you get all kinds of nasty things thrown at you. So somebody's asking about KPT. I know that stock. KP Tissue. We don't have any earnings history on KP Tissue. Now, thing about KP Tissue, I'm not sure what the debt picture is on this, but they may have a fair amount of debt. Now, they pay a good dividend. I don't have enough history. I know that this is a spinoff from Kruger. It's an interesting company. I actually like it because I did look into this company, and just give it a second. There you go. This is the reason I like it. Okay, when you see the earnings going from this over here to this over here, to me that's a good progression. So you're going from basically 0 up to $1.62 a share. If they reach $1.62 a share in 2015, you'll be trading at about 11 times earnings if you're at the same price. So to me that smells like a low-risk opportunity. It's not a purple chip though. Okay, so just keep that in mind. So I just want to warn you about that. I'm sticking to the purple chips. Now, KP Tissue pays a great dividend. Okay, it should be able to keep paying that dividend. And I've actually met the management on this company, so I know it's quite an interesting company. So that's not bad. Are there any further questions? Because we're almost at 1 hour. I know some of you have left already. Petroleum services? Okay, let's look it up. I'll find it. Bear with me for a second. Somebody is asking me about petroleum services. Let's just see what we get here. Okay, petroleum services. This is a NASDAQ deal. Petroleum services. What is this? Okay, this is really not a purple chip company. Okay, you can see that by the earnings progression. Doesn't mean it's a bad investment, but it's riskier, that's all. Okay, I see why someone would be interested. Okay, you look at the earnings progression, it looks pretty interesting. But you have to keep in mind, okay, when you see that earnings progression, okay, the earnings line here, this is telling you something about the way this company operates. I'm sure that if you went back in 2010, there were probably a bunch of analysts saying buy this stock. And in fact, the earnings kept on falling, and then, the stock went all over the place. So just be aware that these earnings forecasts change, okay? So I put a lot less weight on what's coming up than what actually happened. I like to see the history. I want management to show me the money. Okay, I want to, I need to be convinced that these guys have a fantastic track record. Now, from what I can see, Petroleum Geoservices it's not a great company by any means. I mean, any company that was earning $1.90 a share and is now earning 80 cents a share, to me that just doesn't fit the bill. So I don't know if you've got it or not, whoever asked about it, but it's a riskier deal. If I was in your position, I would be looking at some of the opportunities on Purple Chips and make some real money. Okay. Okay, now the last thing that I'm going to do here, we're going to look on the website for a second. Wait a second. Okay. Okay. So Mark is telling me that we should have a little quick look at the alerts and updates section here. Now I'm using the Internet Explorer browser, and I've been told that on Firefox this views much better. Okay, so now when you look in the alerts and updates section, okay, you're going to see all the alerts that we did recently. So all the history of everything that we've ever published is always on there. So keep in mind we're always publishing stuff, and we might actually be putting out an alert very soon. You'll get a heads up about it's Broadcom. So I'm giving you a little tip that we might be buying this stock very soon because I think it's quite interesting. So anyway, so when we do publish an alert, every time we publish it, you'll see it on the list here shortly afterward. The other thing, the performance page. Okay. All right. Sorry. Yeah, my system is unfortunately okay. Anyway, so that's it. Oh, there's the performance page. It doesn't look as good. Whoops. Okay. You know what? The performance page has basically the record, which I'm going to show you here. Okay, this is essentially, yeah, you've got the performance page on the website, so you can actually see, all the open positions that I'm talking about are on that page. So I think that's pretty much a wrap for today's webinar. This was the Q3 webinar, and I want to thank everyone who took the time to sit down and watch this. Please send in your questions. Feel free to contact me. You can phone me. You can email me. Contact me through the website. I'm easy to find. You can Google me, whatever. I'm not hiding from anyone, and I'm real easy to find. People are always surprised. See, that's my wife calling again. She's very persistent. So, so anyway, if you need to reach me, don't be shy. Just give me a call. I'm always happy to talk to all people that are embracing the Purple Chips approach, because I really think in my 29 years in the business, this is absolutely the best way to invest in stocks. So thank you very much, everybody. It's a wrap, and so this is John Schwinghammer, author of Purple Chips, signing off and thanking you all for your participation in this. Thank you.